How are your clients diversifying away from the Mag 7? Are they overinvested in them?
Well, I mean, so beauty's in the eye of the beholder, right? So there's a lot of research that suggests, look, if you are invested in the market, the market's determination is this is what these stocks are worth, and they're invested where they should be. I think a lot of our clients, though, are looking at that, and obviously on Envestnet, we're talking about retail clients with advisors managing their assets, and they look to diversify in other places. They look to have an overall globally allocated portfolio that has international investments, that perhaps leans a little bit into small caps. But let's be honest, if you are, more than 50 cents on the dollar that goes into our platform goes into passive assets. So if you're there, you've got a ton of, you said it yourself, it's 30%, right, of the S&P. But even if you're in an actively managed strategy, it's very hard at this point to have a ton of tracking error to the passive index because it's performed so well in the last several years.
Dana, there's a couple of different ways that we can look at tech companies now. You have software, hardware, enterprise, and then the consumer focus. How are you thinking about how to bucket these sorts of investments going forward and the sorts of catalysts you're looking from each bucket?
Well, so I think, for the average client on the platform, it's more about the sector, and it's more about where is the sector from a market cap weighted perspective within the indexes? And then if you're in, say, a Russell 1000 growth actively managed strategy, how is that manager doing that bucketing? How are they thinking about playing the AI trade, for example? Is it a question of, do I diversify again away from, say, an NVIDIA, right? And this has been a big struggle for them because, you have to meet 40 Act rules around diversification in a lot of cases. And it's hard to do when you have more than 50% of, say, the Russell 1000 growth, invested in these Mag 7. And so I think that bucketing helps, where a good active manager who's able to look at the tech sector and say, okay, I see opportunity sets maybe in some of these suppliers to big, to the Mag 7, right? And these different parts of the market where I can still kind of take that growthy bet on AI and tech, but not necessarily, be so heavily focused on the Mag 7 and, not meeting those diversification goals. So I think that's something that, these managers struggle with. And every time we see sort of a dip, it's a question, is it a buying opportunity to kind of leg more into those types of things as opposed to actually diversifying? That's kind of the question.
Where can we find certainty? And I know that's asking a lot given these days, but when we think about where we can see the tangible return, you have concerns around infrastructure capacity, and then at the same time in consumer, you just don't really know how these sorts of features are going to be monetized. Which one do you think holds more certainty for investors?
Well, I mean, I think the energy theme has been a huge one. It comes across, and so we sit at the junction of hundreds of asset managers, so we kind of get a good sense of where the zeitgeist is sort of leaning. And I would say to you that the secular trend in energy has definitely been a theme. I also think people understand that this administration is probably going to be not only pro-growth, but helpful in terms of energy centers, helping the energy sector in general here in the U.S. And I have a view, that we're going to have to meet the energy demands over the next several years and into the next, decade, et cetera. You're going to have energy sources from everywhere. It just is what it is. So sustainable, yes. More traditional incumbent, yes. We're just not there yet to kind of transition over to sustainable. So I think energy is a play that probably a lot of investors have focused on for this. And, particularly with this administration, they see the opportunity set there. Even before AI, right, our energy needs were going to increase. Just looking at demographic trends, population growth, parts of the world that are moving into a better standard of living, which is what we obviously want to see. But all of that is going to create energy demands even before you get to the AI trade.
Growth versus value. It's a debate that I've been having with guests since I started doing this. Is this finally the year? I mean, growth has won every year I've been doing this. Is this finally the year that we see value outperform?
It is so hard to be a value manager. Here's what I would say. January effect is interesting. It's not statistically significant, but there's a little signal in there. January did see outperformance of value. I think, look, the notion that we are higher for longer on interest rates, traditionally speaking, that should benefit value, right? Because more of those cash flows are coming earlier. And so when you have a higher discount rate, the growth stocks should theoretically be impacted worse by that because they have more longer dated cash flows, more years that you have to discount by a higher number. So yeah, theoretically there's some makings for that there, but we all know the AI trade can just, and or other secular trends can just blow that out of the water. So it's very hard, I think, in the short run to say what will win, what won't win. I will say, I think at the end of the day, valuation will always still matter. It matters more for medium-term expected return. To try to trade on it in the short run is, it doesn't have a good track record for that.